Hello, everyone, and welcome to our September investment market update. Today, I'm delighted to be joined by Ben Palmer, who is the lead sustainable portfolio manager at LGT Wealth. Hi, Ben. How are you?
Yeah, very well. Thank you, Mike. Thanks for having me on.
Not a problem. Great. Right. So what we tend to do is jump straight into these things. I believe you've got some slides, if you have to bring those up. And what we'll do is we'll just have a conversation. You walk through them, and probably I'll jump in on occasions just to interrupt you and have a bit of a chat, if that's okay.
Sure, absolutely. So hopefully
Fantastic.
that's popped up for you and
Yep,
for
that's all up and running.
fantastic. Well, really, what I wanted to run through today is firstly taking a bit of a look at the macro overview and our views on it. It's obviously been a particularly volatile 18 months to 2 years now, but certainly looking with a view looking forwards. And then we'll unpack some of these key areas which we're thinking about internally at the moment and how they translate into portfolios. And then I just want to finish off focusing a little bit more on the sustainability outlook as well, given, again, it was a pretty challenging market environment for everyone last year, but sustainable portfolios tended to hit some more buffers than core portfolios, but highlight some of the reasons which we think there's some really interesting opportunities in markets as we stand here today. So some of these factors will be relatively familiar to hopefully a lot of you watching because they've dominated news flow over the last 18 months or so now, predominantly inflation and interest rates. And 2023 has been a year where we've been focusing on falling inflation, which is quite nice given what we saw last year. But this has come at a time and being driven by in part by rising interest rates. And that kind of dynamic between the two has been or continued to be a keen focus for investors and markets. Looking at interest rates, we do believe that we are now near the peak of where we're likely to get both in the US and within Europe and UK. Markets are currently pricing in maybe one more rate move in each of those areas before the end of the year. And then focus is very much moving towards when are we likely to see maybe interest rate cuts? At the start of this year, the expectation was that we'd already be in an interest rate cutting environment now. But because the economy has been, in broad senses, much more robust than many thought, we are not there yet. And actually, expectations now are that we are in this higher for longer environment where we're likely to stay at these elevated levels for a longer period of time. And actually, maybe into 2024, not see any sort of rate cuts until the second half. So we've been thinking about what does that mean for both the economy, but portfolios as well. From a recessionary environment perspective, then given the levels of rate moves, there has been quite a lot of expectation that this will drive down economic growth, which is already relatively fragile in certain elements. And certainly we're in a low growth environment to the point where we see a recession. As I say, actually, in general speak, particularly in the US, the economy has been much more robust than many have expected. However, we are beginning to see the impacts of interest rates start to feed through into the economic data. And our base case is that we are likely to see a mild recession come through into certain economies, particularly maybe the UK and potentially the US. The important word there, though, it is mild. And there is a big difference between a mild or shallow recession, which tends to not really leave too many long-term economic scars, and you tend to be able to sort of bounce off back towards growth relatively quickly, and a deeper recession, which is certainly a risk, which I'll come on to, but isn't currently our base case. In this particular market, we are seeing some divergence now in performance, and we do think that it is really important, and more important almost than ever, to be very particular in terms of where and how you're positioned within markets. As we move forward and with a focus on this idea of being at higher interest rates for longer, we think this will become more important because companies that are more stressed, that do hold higher levels of debt that they are struggling to service and will have to service at those higher interest rates for a longer period of time, will likely underperform in our view. And therefore, we do think that discretion in equity selection is of paramount importance. We've also been looking at economic activity, as I say, on a broad sense, then it has seemingly been more robust. And I've mentioned the US in that frame already. But actually, if we look out to the east, where the expectations at the start of the year were a lot more rosy, it has disappointed, with particular reference to China. After their COVID reopening, we had the initial bounce in optimism, given the pent-up savings that the Chinese consumers had, and the fact that we felt that this would be sort of dissipated into the economy. That hasn't really come to pass to the levels that was expected. We've also seen some structural challenges in China, particularly around areas like their property market as well. And we'll come on to have a look at that in a moment. And then finally, just looking at some of those risks, our base case, as I say, is kind of a very low growth environment or maybe a mild recession, but ultimately leading into to more growth as we look into the not too distant future. But given the very in some senses chaotic economic environment we've been in, there are still two tail risks that we see as being plausible. One being a sticky inflationary environment, or a re-emergence of inflation is probably a better way of putting it. And we're beginning to see some indicators of this with energy prices moving back up, but ultimately feeding into the fact that inflationary pressures continue and rebound even with these higher interest rates. The other tail risk that we see is more that deeper, longer lasting, harder hitting recession, where actually the higher interest rates really begin to bite and economic growth is reversed to a degree, which has some deeper economic scarring and longer term implications for economies and to some degree the companies within broad investment portfolios as well. But as I say, those are tail risks in our minds rather than our base case. So just unpacking some of those things a little bit more, taking a look at inflation, these charts just give a view, primarily focusing on the first half of the year of the journey that we've had, certainly on the right-hand side of these charts. And apologies for the color coordination, it's not the most helpful because it's hard to differentiate. But what you'll see on the chart on the left is the squiggly line that is lowest towards the end is the US. And what we've seen is that their inflationary pressures have weakened faster than Europe and certainly the UK. They are less exposed to global energy markets and global energy shocks, and that has certainly been a help for them. But ultimately, their disinflationary pathway, as it's known, has been quite quick compared to Europe and the UK. Europe is somewhere in the middle, and you'll see there at the top, the UK has struggled more than most to bring inflationary pressures under control. And there's many factors for this, but two of the large ones are that we do have a very tight labor market, which ultimately means there's very high levels of employment, and there's been lots of wage growth coming through into the economy, which ultimately leads to greater spending, which can help drive inflation. And we are, like Europe, more exposed to energy prices in terms of our inflation, which has been more challenging. And then there are some associated risks around our particular economic outlook and Brexit and things like that. So the left chart I should highlight is looking at headline inflation. So this looks at, a very broad basket, but importantly includes those highly volatile areas of food and energy prices. Core inflation on the right-hand side essentially strips out the impacts of energy and food. And what you'll see here is it's actually been a lot slower at coming down than that headline, because we've seen energy prices from the start of the year fall quite considerably, which has very much helped those headline numbers. The core inflation leans more on sort of service sectors and kind of consumer information and data points. And we do historically tend to see that this lags headline inflation, but it has been a bit worrisome, certainly through the middle of this year, at the fact that it was becoming challenging to see those numbers come down. But like the history books have shown us, that is now coming down at a faster rate, which we do think is obviously quite appealing from a market perspective.
Just quickly on that, I think obviously we just had some inflation figures out today, and the fear and the concern was that inflation would have ticked up a little. In fact, it's actually come down marginally, but that's sort of undershot a lot of the economists' expectations. And obviously the reason for the uptick, or they were anticipating uptick, was that we're starting to move into the winter season and oil prices have lifted. But interestingly, when I was looking at the ONS data earlier today, it does seem that costs associated with properties and also going out, and there seems to be a reduction in demand for hotels and restaurants that seems to be coming through. So does that sort of indicate that maybe the Bank of England have done enough and that that's a good indicator in that sense? What are your thoughts on that?
Yeah, it's certainly something that we are considering, and this is something that's been front and foremost of our minds for some time now, this idea of long and variable lags of interest rate policy, that in general, it takes over a year for the impacts of interest rate rises to actually feed through into economic data. And some of the things you highlight there are really important and interesting, and particularly in the UK context tied to the mortgage market, that we all know where mortgage rates have got to. And one of the effects of that is I think the figures around 1.5 to somewhere between 1.5 and 3 million households are remortgaging this year. As those come up for remortgaging at much higher rates, then that basically sucks excess capital and discretionary spend out of household purses. So we're less likely to go out to the restaurants once a week or once a fortnight if we're having to spend much more money on just keeping a roof over our heads. So as these kind of mortgage rates start to really feed into the economy, we do expect to see that have an impact on inflationary data by just sucking some of that discretionary spend out of other areas of the market. Because yes, it'll have an impact on house prices, but ultimately when you look at where are we likely to focus our money, it's on keeping a roof over our families' heads and feeding them. So those more those other wider areas of the economy are likely to see some weakening on that basis, which ultimately feeds through into some of those core inflationary numbers.
But I guess the other point to then think about is, well, whilst we are seeing those inflationary pressures coming down in those particular areas, the core inflation, is it coming down quick enough? And is it coming down as fast as they anticipate? And therefore, does that therefore mean that they're going to increase the rates a little bit more? And I think that sort of really brings you onto this, doesn't it, where you're talking about policy rate forecasts and what's going to be happening with those.
Yeah, I think because of the rate of inflation has been harder to come down, and certainly the core basket, policymakers and central bankers have been very keen to emphasize in pretty much all of their communications that they're data-led and their primary focus is on bringing inflation back down towards target levels of around 2%. Around developed markets, and they are willing to compromise economic growth to achieve that target. I think because we are beginning to see some of that data and the impacts of interest rates, if you look at the chart on the left, which shows for over a long time period, but the interest rate policies of the UK, US, and Eurozone, and just how quickly we have gone from essentially 0 to somewhere between 4 and 5.5. And the fact that, as I mentioned, it does take time for these to feed through to the economy. We are already done a lot of tightening. And I think that some of the communications we've seen more recently is that they're starting to see the impacts of that. And it does allow them or give them the ability to take the foot off the pedal a little bit more. And as I say, the expectations we've got, central bank announcements this week. And the expectation at the moment is that the Fed will pause for the first time in a long time in terms of interest rates this month. And absolutely, they have tightened to a large degree now, and I think it would be their preferred method to stop raising interest rates if they see an opportunity to so, or certainly pause. And as I said, I think now that we view the rate rising cycle nearer the top, our focus and the market focus and central bankers' focus is really on, well, how long do we stay at these levels of these quite restrictive policies, and at what point are we able to start relaxing them? And that really talks to the chart on the right, which is sort of encompassing a forward-looking estimation of where interest rates will be over the next few years. And you could say that this is maybe one of the more dovish or optimistic in terms of interest rate cuts. I think the expectation now is, particularly with the US in mind, of maybe 2 rate cuts next year and more focused on the second half of next year. So if that comes to pass, that means that we're going to be living in this kind of higher 5.5% rate environment for probably 6 to 12 months, which we think is really important to consider for investors, in as much as a lot of companies will absolutely be able to not just survive, but thrive at those levels. The well-run, well-managed companies with, efficient balance sheets and strong revenue growth and addressable markets. But those ones that are more stretched and that do have higher debt and higher servicing cost and maybe dwindling market share will come under more pressure the longer they have to stay at those levels. And that points to the fact of why we think you do need to be quite focused in where your equity exposures are currently. But as I say, from a broader market point and perspective, the fact that we are nearer the top and we're now thinking about interest rate cuts, or at least remaining stable, we think is a positive for risk assets, because a lot of repricing has already, on the negative side, has been taken into account.
Brilliant.
To move on to a little bit of a retrospective look at just the market performance of this year, then maybe a lot on the call would have seen some headlines in terms of the strength of the market, the equity market. And certainly if we look at, again, focusing on the US as the largest market and our largest underlying equity exposure, then the S&P year to date is up somewhere in the region of 15%. But what has really driven that performance has been a very small subset of the market, and really drives down to around 7 or 8 technology names that are associated with the expected boom in artificial intelligence. And there's a couple of interesting charts here to show this. So on the left-hand side, you've got the NASDAQ chart or performance, which is a US technology index, which is the line which moves up at a pretty fast pace through the course of this year. And then you've got the equal weighted S&P 500, which is the broader US market, and it just weights all of the constituents, all the 500 companies evenly, whereas the standard index does it according to the size of the company. And it gives you a view that it's very much been technology that has driven this market over particularly the first 6 to 7 months of this year. And actually the chart on the right breaks that down a little more in terms of the names of the companies that have really driven that performance. And as you'll see, they are predominantly technology focused names, and it puts it in kind of monetary terms there. But I think the most interesting one there is the second to last name on that chart, i.e. the remaining 490 companies in the S&P 500 have actually contributed a very small component of that performance. So what this really means for an investor is that, yes, it's been a more positive market environment this year, and portfolios have benefited from that in aggregate. But unless you own those 7 names in a very meaningful proportion, then you are unlikely to achieve the returns of 15+% that the headline index would have you believe. So it has been a very narrow market. We have seen some of this reverse over more recent times, and we think the benefits of diversification are really playing through now. So I just think it speaks to the fact that it's been a narrow market, and the benefits of diversification are really coming back into play now. Moving on to China, which, as I say, has probably been the primary problem child for global investors this year, given the levels of expectation of their COVID unlocking at the end of last year, and what's actually been delivered. Again, a couple of charts here, so I'll just quickly explain them. The first one is really looking at the Chinese property market. And the property market has been probably in the eye of the storm and caused a lot of the issues that have filtered out into the wider economy this year. And after a long period of construction and new house builds and wealth creation through home ownership, we've seen a big reversal in terms of property values and actually a lot of insolvency in the property market in China. And this has really deteriorated and had knock-on implications for Chinese middle classes who own properties, who've seen the values of those properties go up quite considerably over the years, reverse at quite a fast pace, has then eroded their confidence in other consumer spending and investing more broadly. And this is shown on the chart on the right, where you'll see actually the start of the year and the end of last year, an uptick in that measure of consumer sentiment. So basically, as the line moves up, it's saying that Chinese consumers are becoming more positive and more willing and open to spend. Then that sharp reversal through the rest of the year as consumers have become a lot more negative on the outlook. And there are some more scary statistics with China in terms of youth unemployment is north of 20% at the moment. So we are keeping a close eye on China. We do have exposure there. We do still think that, particularly with the sustainability hat on, there's a huge amount of market leadership in very key technologies that are based in China. We always do that with a very kind of risk-first approach, and obviously a very prudent approach to sustainability management. But with those risks there, valuations are actually looking very attractive on a longer term basis, trading at 7 times multiples, i.e. a very low level compared to historic averages. So we're not overly exposed to China, but we do see reasons to maintain some exposure. And also, if we look back to history, the Chinese policymakers do have a lot of firepower at their disposal, which they haven't really put into force to any meaningful way just yet, but they have started to make small moves, which we think will be built on over time. So the very weak sentiment we've seen towards the Chinese market, there are concerns there, but we do think that there are policy actions potentially in the pipeline, which will help reverse that. And given the level of valuations at the moment, we think for a longer term investor who's willing to wait, that there are still reasons to maintain some exposure. So just wrapping up on the kind of more core macro overview before I move on to more the sustainability landscape, then as I mentioned at the outset, we do have a base case here of a soft landing scenario. And soft landing really is trying to highlight the case of that policymakers navigate this reducing inflation environment with the higher interest rates without crashing the economy, essentially. As I said, we would also include in this scenario a very mild recession that doesn't really leave too many long-term scars. And that is our key thesis that we build the majority of our portfolios around. So with this in mind, we are neutral equity. As I say, there's risks out there, which I'll come on to, but we don't think it's time to put the tin hat on and kind of crawl under the bed. We think if you're willing to ride out a degree of the volatility that we've seen and where market valuations are now, there's plenty of reasons to be optimistic over the longer term. However, as I say, we do need to be conscious of and guard against potential other plausible outcomes, i.e. the inflationary scenario, which I mentioned, that we see a resurgence this winter and core inflation starts to tick up again, and interest rate policy hasn't been as effective as we have hoped and think at this point in time. So with this in mind, we do have assets in portfolio which have explicit inflationary protection attached to those cash flows, which should help guard to a degree in those types of environments. And then the second risk factor is that harder landing scenario, the fact that the economies do have longer lasting recessionary scars. We are carrying in our portfolios a more elevated position to cash than our historical averages, to guard a little bit against this and to provide a little bit of opportunity capital. And we also do have holdings such as longer dated gilts, which again should perform well if we see any sort of UK recessionary fears or markets. So that's certainly, as I say, not our base case. We do have a slightly more optimistic outlook than that, but just in a year where we think caution is prudent, we do want to provide some degree of protection against those more tail risk environments.
So Ben, just on that, if I can just sort of summarize, it seems to me that the interest rates rises are possibly near peak across the US, the UK, and the Eurozone. It looks from the graph that the Eurozone will reduce their rates possibly quicker than the US or the UK. The main theory or the main reasons why inflation has been sticky for us has been mainly down to energy costs, but then also the fact that we've got quite a low unemployment level, which means there's a lot of demand for the same number of people in the UK. Therefore, we've seen wage increases. So whilst there is a cost of living crisis, it has been eased quite significantly by the increases in salaries, which probably will go quite some way towards the increase in borrowing costs. So the question is, how much further do the Bank of England go? And are they only going to really be hurting a small portion of people, because there's already been a significant number of people remortgaging in the last 12 months, and it's a case of when's enough going to be enough. But all things being equal, we hope that we're at the top of the interest rate cycle, and if interest rates start to come back down, that will encourage businesses to invest, that will make valuations on companies look more favorable, and then we'll start to see some traction, some movement and growth going forward. Is that a fair sort of assessment?
Yeah, I think it's a very good summary, better than I probably could have put it myself. I think the key thing for us on interest rate policy is said, we are very much of the view that we are near the top. As I say, we're kind of pricing in markets, in our general view, maybe one more rate move. And then it is the question of how long do we stay at these levels? But where we gain a lot of confidence in our portfolio management style and the sustainability characteristics that we have in our sustainable strategies is that we do think that that focus on quality business models that are running tight, efficient ships, that are, particularly with a sustainability view, looking to address challenges that have growing market share and longer term revenue growth expectations. These companies, we think, are robust ultimately and resilient. So we think they can exist and survive and thrive in that higher for longer scenario, whilst other competitors and companies that, as I say, might be less resilient, less well run, more indebted, will struggle. And then absolutely, if we see interest rate cuts, as I say, is still priced in for the back end of next year, maybe not to the same pace as was projected at the start of the year, then that will be beneficial for risk assets broadly. We'll see a slight reversal of the trends we saw last year, but we see that very much as kind of the that will be the extra boost to our portfolios, rather than that's the sole catalyst for any sort of meaningful re-rating of portfolios. And we've seen re-ratings to date this year from the lows of last year. So I said, the US market, albeit driven by a small number of companies, but even more broadly, markets are generally up this year, apart from China's sort of obviously being the problem child, and portfolios have benefited from that. But I do think this sort of stable economy or market environment and interest rate environment is what companies are looking for, a degree of stability. The challenge over the last 18 months is they're constantly readjusting to a new sort of interest rate policy and the implications of that. So yes, say that's a longer-winded way of saying what you've said, but I think there are certainly reasons to be positive looking forwards.
Brilliant.
So Joe, I just wanted to kind of pivot slightly and concentrate a little bit more in terms of the sustainability outlook, given the market environments that we've seen over the last 18 months to 2 years. And something that we keep a keen eye on at the beginning, on the first quarter of each year, is something called the Global Risk Report, which is published by an organization called the World Economic Forum. The World Economic Forum are essentially a group of business leaders, politicians, academics, investors, and scientists that all come together, and really what their primary motivation is trying to map out what are the largest risks to the global economy and environment and society, historically over a 5-year period. But given how many changes we've seen over the last year, or in 2022, what they did this time is look at a very short time frame of 2 years, and then an elongated time frame of 10 years. And what we find encouraging from a sustainable perspective is that absolutely, given the start of this year, the number one risk to the global economy was viewed as the cost of living, given all the inflationary pressures. But even underneath that headline number one risk, in that top 10 list, there still remains a huge amount of very key environmental and social risk factors. And then actually, as you elongate timeframes back out, as long-term investors, we will focus on more, then top of the agenda still remains the failure to mitigate climate change, and also to adapt to climate change that's already happened, as well as things like large-scale involuntary mass migration, and a lot of other areas which are encompassed in our investment strategies. So this, at a very headline level, obviously is worrisome, but also from an investment perspective gives us comfort that actually we don't think 2022 in any meaningful way knocked the long-term megatrends that we're trying to invest in these portfolios off course. And actually they are sort of very much structural shifts that are, don't necessarily pay huge attention to whether we are in expansion or contraction phase. If interest rates are going up or going down, these challenges remain and they need to be addressed. And one of the key reasons for that is that there is very much a financial cost associated with them. And this is probably most evident and measurable in the environmental and the climate change arena. So this chart here, or infograph, is looking at the US in 2022. And what it highlights is that in that calendar year, there were 18 separate billion-dollar climate disasters or more in that period, totaling with a total price tag, I should say, of over $165 billion. And what this really hopefully evidences is that the cost of not addressing climate change is huge. So we hear a lot about the cost of the energy transition is going to be large and quite significant. And, from a policy perspective, hard to get through at times. It's going to be a bumpy road. We're going to see pushback, as we have seen through the course of this year in certain areas, against the climate agenda because of the perceived cost of it. But I think what underpins all of this is the other side of that the cost of doing nothing is actually multiples and far exceeds that. And again, it's very worrisome, but in terms of what entrenches our view that sustainability trends are mega trends that haven't gone away, is that this picture, policymakers understand this. And that's why we've continued to see increased commitments from global governments around things like the energy transition, even after a year or during a year like last year, where we saw the Russia-Ukraine situation, the huge spike in oil prices, and maybe more of a societal view that the energy transition has been knocked off course. We're all worried about just getting energy from anywhere as long as it's not Russia. But actually, when we dig underneath the bonnet of it, what the challenge of Russia-Ukraine highlighted was the need for greater energy resilience, independency, and And the only way that the vast majority of nations get there is through a rapid expansion of renewables, because we can't just magic up oil, gas, or coal reserves underneath our national borders if they don't currently exist. Whereas you can build out a blend of renewable technologies, which will give nation states that greater resiliency and independency over their energy. Because another thing that's leveled at renewables is that it's a highly volatile price market, because of the intermittency challenge. And yes, that's a challenge that we are overcoming. But I also think it's important to highlight that we shouldn't be blind to the fact that oil markets are hugely volatile. We've already evidenced it a couple of times in this chat that, over the last 2 years, we've gone from basically negative oil prices up to $100 oil prices, down to $60 oil, and back up to 95 as we sit here today. And we're essentially at the beck and call of a very small number of states who decide what price they want to sell oil at. And a lot of those countries in a pretty, tenuous geopolitical state. So, yes, it's not turning a blind eye to the challenges of renewables that we are looking for technological developments in, but let's also acknowledge that the current energy system has a lot of challenges and volatility associated with it. And as I say, I think what we find supportive of this and encouraging from an investment perspective is that governments are still moving ahead with their ambitious plans and supporting that with real fiscal and taxation and monetary support, as evidenced here. China last year, over $500 billion worth of spend. The Inflation Reduction Act in the US, about just under $400 billion. The EU's response this year, around 500 billion euros. And the chart on the left is just showing that actually last year was a really interesting point at which we saw new money, so capital expenditure on wind and solar, exceed that on new oil and gas. So if we're taking a forward-looking measure of energy markets, we passed a really important point last year, and the International Energy Agency's expectations of this year is that globally about $1.7 trillion, and they take a broader assessment of the market than the figures shown here by The Economist, but around $1.7 trillion globally spent on renewables or invested in renewables, as opposed to just over $1 trillion invested in oil and gas. So again, I think just in terms of the direction of travel, it's pretty positive.
A big shift change there. Absolutely. Brilliant. Ben, it's been an absolute pleasure. Thank you very much for coming on today's call with us. It really is appreciated. Everyone, thank you very much for tuning in. Please join us on our October webinar, which we will release in hopefully a few weeks after this one. Thanks ever so much.
Thanks, Mike.